And we are live in 1, 2, 3 now. So hello guys, welcome to today's class. How you guys doing? Good evening. Lydia, Brianson, and Beverlyn, good evening.
Good evening.
How are you guys doing? So I hope you guys are doing good. Hope you guys had some revision, whatever we talked about in the last class. The last class we talked about introduction to forex trading, whereby we covered what is forex trading, the sessions in forex trading. Cover something on they're going to cover something on um, trading, whereby you're going to cover currency pairs, going to cover lots, pips, leverage, margin, whatever we were talking about in the last class. We're explain. So the first thing we're going to cover today is currency pairs. So in forex trading, we said we trade currencies and the fluctuations of the currencies. So forex trading involves buying of one currency while simultaneously another, and currencies are traded in pairs. Now, these pairs that you're trading, they are categorized into three types of categories. We have major pairs, we have minor pairs, we have exotic pairs. So major pairs are pairs which are linked to the US dollar, because the US dollar is the base currency of the world. Each country in the world, okay, almost 90%, except the Greeks, store that do business in the dollar. Oil is traded in dollar. Tea is traded in dollar. So dollar is the base currency. Now, what are the examples of these major currencies if they include the dollar? I'll stop sharing my screen, then I'll ask you randomly. Start with Beverlyn. Beverlyn, what are the examples of these major currency pairs?
Euros dollar.
Euro versus dollar, we call it Euro USD. Lydia?
Euro JPY.
No, that's not a major currency pair. I said any pair that is linked to the USD, anything with the USD.
USD JPY.
Yeah, now that one is a major currency pair. Branson? Branson, can you hear me?
Oh, British pound versus US dollars, GBP USD.
GBP USD is one. Okay. Another one. Any other suggestion?
USD CHF.
USD chaff. Okay, that's a major currency. There is USD card and many more. So getting back to our presentation, those are examples of major currencies. Now, minor currencies, in the other hand, are currencies that are not linked to the US dollar. Example, Lydia, I'll start with you. Lydia, you gave me one as an answer when you're starting, so you can give me an example of a minor currency pairs. Beverly, do you have any idea about that? We have listed ones with the currency with the USD to be the major currency pairs, which are the Euro USD, which is the euro against the US dollar, which is the most traded pair. We have GBP USD, which is the British pound against the US dollar. We have the USD JPY, which is the US dollar against the Japanese yen. We have the USD CHF, which is US dollar against the Swiss franc. We have the AUD USD, Australian dollar against the US dollar. Then we have the USD card, where US dollar against the Canadian dollar. And we said these are the major currency pairs. Now, let's talk about the minor pairs. Minor pairs are cross currency pairs, or they have no USD involved. And as I was asking, Lydia gave us an example of a minor pair. So, Lydia, you can just still give us your answer. Name one minor pair that you know. Branson, any minor pair?
GBP JPY.
GBP JPY. That is the Great Britain pound against the Japanese yen.
Yes.
Beverly,
Euro GBP.
any idea?
I have no idea.
You have no idea, okay. Lydia, any idea? Okay, ni kama Lydia is going to cook or something. So we'll continue. So the minor pairs, the US dollar, but still have significant trading volume. That is the euro against the British pound, which is euro GBP. We have GBP JPY, the British pound against the Japanese yen. We have euro AUD, which is the Australian dollar against the euro against the Australian dollar. We have the euro JPY, the euro against Japanese yen. There are many, but now these ones are the most commonly traded. That's why they're listed here. Then the third group, we have something called exotic pairs. The high volatility, but low. They have high volatility but low liquidity. So these pairs have one major currency and a currency from an emerging economy. So we have the USD, the US dollar against the Turkish lira. We have the euro against the South African rand. We have USD against the Mexican peso. We have many of them. We also have the US dollar against the US dollar against the Kenyan shillings, the Ugandan shillings, Tanzanian shillings, Congolese franc, whatever. Those are emerging currencies against a what? A major currency. The euro against the Kenyan shillings, and so on. Those are exotic pairs. These pairs have high volatility but low liquidity. No less people trade them. But they move. Their changes make time. They make changes anytime. But now they don't have a lot of volume. A lot of people don't trade these pairs. So that's why when you look at the forex, most forex brokers do not offer these exotic pairs, and if they are offered, they are not tradable. That's a point to note. Now moving on to the next. In forex, there are terms that you'll have to come to terms with them. You have to understand them, because when you tell somebody you're a forex trader, there are things you need to understand. Yesterday, the other time, I had Lydia was saying that she does not know how to calculate pips. Branson, do you remember that?
Yes.
Now, today I want to introduce I want to introduce the topic on pips, lots. We're going to introduce pips, lots, bid, ask, and spread. All of them are going to be introduced into this introduction to forex trading, the basics. Now, let's understand the bid, ask, and spread. In forex trading, every currency pair has a bid. It's more like the selling and buying price if you did a business course. Now, this one, the bid price is a price at which you can sell a currency, while the ask price is a price at which you can buy a currency. Now, let's talk. Most banks, when you go inside, you'll find showing something like let me look for what you're talking about.
Right.
Exchange rates. Now I want to show them an example of how it looks like. Showing different exchange rates of different currency pairs. For example, you'll find there the US dollar against the Kenyan shillings. You can buy 127, another at 129, depending on the rates. I'm not going to give out the accurate rates. So most banks, when you go, you'll find something like this. Just a little bit. Find something like this. You'll find something like this. You find something like that. The bank is displaying something of that sort. Now, those are the rates and price. The bid and ask price do not look, they are not similar. When you do business, while you're selling, when you're buying, for example, you're selling sugar at 140, but you're selling at 150. Now, when you're buying, your buying price is what here we call the ask price. But the bid price, your selling price is what we call the bid price. Are we together up to there? Kila mtu anaelewa? I'm still teaching concept, so if you cannot kindly just ask that question right now, because today's lesson is going to be at least a bit longer. Evelyn, do you have a question? I can't get you. Do you have a question?
No, okay.
Leader.
No.
Okay, so I was saying our ask price is more like a buying price and our bid price is more like a selling price. So when you're buying a commodity to go and sell it, with the price at which you're buying at, that's what we call an ask price. And the price at which you'll sell at it is what we call a what? A bid price. Now there's something called spread. Spread is the difference between bid and ask price, which represents the broker's commission after your trade. Now, I was using an example of you're a shopkeeper. After you have bought it at a different price and sold at a different price, the difference between those prices is what you call a what? You'll call it profit, but here we'll call it spread. That's why when you're going to select a broker, you're being told to look at the spreads that different brokers offer. Now let's talk about the technical part of this exercise, the bid price, ask price, and spread. Now let's USD. There is an image being portrayed on our screen whereby we have Euro USD having a bid price of 1.2880 and an ask price of 1.2885. Now, the spread, I want us to calculate the spread of that bid and ask price. So our bid price is 880 and our ask price is 2.885. Our spread automatically becomes, but Bryson, what's our spread? Ransom? I'll go with Lydia. What will be our spread? Don't say what is written there. Just use your basic. If our bid is 1.2880, 1.2885, what will be our spread?
I'm supposed to minus, isn't it?
Yeah, you're supposed to subtract. You'll be subtracting the ask.
0.005.
0.005. Now, 0.005 in USD, in the Euro USD, we calculate pips from the fourth decimal. So that becomes 5 pips. I'll touch on later. Now, as the spread here is 0.005. Are we together up to there?
Yes.
Now, the tighter the spread, the cheaper it is to trade. Major pairs have lower spreads, while exotic pairs have higher spreads due to low liquidity. Now, when you're choosing a broker, choose a broker who has lower spreads, which makes it makes it cheap for you to trade. Don't go for a trader a broker who has higher spread, because they're going to hurt you. Because automatically, when you input a trade, the broker has already made money before even you losing or making that money. Are we together on that?
Yes.
Now, so any questions on the bid, ask, and the spread part?
Yes, I have a question.
Okay.
Okay, I didn't learn basics much because
Mm-hmm.
now I was wondering, on my opinion, nilikuwa naona kama bid na ask price hazina importance sana, bora uingie kwa market utengeneze pesa.
The importance of them, ama bado hujaona?
Upande wa spread,
Mm-hmm.
because I always hear people saying that you cannot trade currencies using derivative because the spreads are high.
Yeah, that is true. Our derivative person can talk about that, but I don't want to mention any broker on my stream because you're live right now. It will work as defamation. Na tuna lawyer. But it's fine. So let's tune that part of bid, ask, and spread.
Okay, I've understood about this, but now spread and bid, isn't it?
Every
Yes.
pair has
But
okay, not every pair, but every tradable asset has an ask price and a bid price.
Yes.
now let's say you are trading something.
Mm-hmm.
Are those trades that much important? Because
Yes.
now when you lose, when you gain, you just place a trade. When you gain, you gain. When you lose, you lose.
Okay,
Yeah.
Bryson, do you want to explain that?
Yes, Lydia, sometimes
Yes.
I'm sure you've seen the market during midnight and you get the spreads that sold.
Yes.
Sometimes you get to the spreads are like in gold, you're supposed to buy at 46.60 and the spread is at 46. You see, or a pair JPY, you get when you want to buy when the spreads are worse or when the ask price and the bid price differ, it makes you wait longer to get your positions into profits. So it matters a lot. And in other times,
Yes.
in
Yes.
other times you get yourself in the moment you want to maybe swing trade. So you bought like right now at a very good price because the spreads and the bid price and ask price are just okay. No. So when the market closes and it opens, you get the ask price is above your is above your entries, and the bid is also below your entry. So you are at the center of the market. You see.
Yes.
So you are not sure of which direction the market is going, and you get at some point you have to wait from midnight around 1 p.m. to 9 a.m. in the morning, maybe London open 9:30, around 9:30 London open for you to be in profit. So sometimes it matters a lot. That's why sometimes they tell you to get a broker with good spreads, and sometimes with hii asikuwe na swaps sana.
Oh.
Branson, Lydia is more of a synthetic trader, so she thinks the spreads don't matter. But you see, once you put a trade on, the spreads are already cut. That's why when you put a trade, it's negative automatically.
Yes.
Those are spreads.
So
Yes.
the sessions when like maybe at night now the spreads are higher, meaning when you place a trade at night, it will take some time for you to be in profit, isn't it?
About their pairs. when you trade them at when the market opens. The market opens at 3 around 3 a.m. and so around 3 a.m. when you're putting a trade, for example Euro USD, and that time the Asian session is on, the spreads tend to be higher for most brokers. Most brokers exaggerate the spreads so that they can make money. It's not that
Okay.
not all brokers make that, but most brokers. Of first, okay, the thing is, if you're using, we call them B book brokers, do expand their spreads. But if you're using an A book broker, the spreads are not that big. Or if you're using an ECN account, the spreads are not that big.
Okay.
Any other question? Lydia,
No.
Beverly, are you contented with whatever I've explained? We can't get you.
I'm saying that the times they're using actually this time.
I'm not getting Beverly, but it's fine. We shall review after the lesson ends. So we are done with the bid, ask, and spread. Now, the other day we were talking about leverage. I've talked about leverage in the last two classes, and today we're going to explain leverage and margin. So, as I said in the past, forex trading, to trade forex, you need a lot of money. You need a large capital. But now, at this point of time, you don't need large capital to trade forex trading. And now the question is, what really allows you to trade with $10 right now, compared to where you need the past, where you needed thousands, tens of thousands of dollars or money to trade this forex, to get into the forex market. And I'm going to explain that. We have leverage and margin. Now, forex trading allows traders to control large positions with a small deposit through leverage. Bryanson explained more about leverage, more like a loan that a broker gives you to allow you to trade. So, from my text, trade larger amount than your actual capital. So this leverage, I'll explain it in diagram form, but in basic terms, is more of a loan, or multiple, or what will say, additional capital given to you by the broker to allow you to open multiple positions with a small deposit. Now, deposit $10, but you're going to be allowed to open more than 3 positions on gold, which is impossible when you're using a smaller leverage. Then we have margin. Margin is the minimum amount required to open a leverage trade. So those are the definitions. We're going to explain them in a more technical example. So let's proceed. So example, there is an example here. You have $1,000. Then you use this $1,000 with a leverage of 1:100. That gives you an ability to trade an account of 100,000 worth of currency. Is anybody lost up to what I've said? Kuna mtu amepotea?
Sijaelewa kidogo.
Who is that? Lydia?
Yes.
This leverage is the ability to trade large amount of than your actual capital. Indio. Then Branson explained leverage. Branson, explain to them leverage as explained it last time. Is Branson here? Branson. So, as I was saying, you have $1,000 in your account.
Yes.
Now, if you trade with this $1,000, you cannot open positions. You have limited positions to open. Now, because of leverage, whereby you're using a leverage of 1:100, they take the $1,000 times the $100,000 worth of currency. Now, instead of trading the $1,000 currency, you're trading what? $100,000 worth of currency. So you can open multiple large positions because of that leverage. Wanipata?
Yes.
Okay, let me make it.
So if it is a leverage, let's say of 1 to 500.
So you have your account balance is?
Let's say it's $10.
Okay.
Yes.
5,000.
Now it will be, you'll be able to open position for
5,000.
$5,000.
$500.
5,000.
5,000.
5,000.
Yes.
But it applies in profit only.
Yeah, but even
Also in losses.
so as much as it's a good thing, it's also a bad thing if the trade goes against you. Branson,
Yes.
give your definition of leverage from the last class.
Hivyo venye tu umesema iko sawa kabisa.
So what I've said is fine.
Yeah.
Now let's do this way. You have what? You have 10,000. Are you getting me, Lydia?
Yes.
1,000. You want to buy, let's say you want to buy cow with 10,000. Are you getting me?
Yes.
Can you be able to buy that cow with 10,000? A full-grown cow?
No.
But now, if you have 10 of you with that 10,000, how much are you going to have?
Yes.
Yes.
Now, have you understand the concept of leverage?
Yes.
Beverly, have you got the concept of leverage? Beverly? Is Beverly in this class? Okay, I'll proceed.
I still have a question there.
Okay.
The reason I was saying, I think it applies in profit only because maybe when your trades are in loss, why can't they add for you that money?
Okay, let me explain to you this.
You will know the account.
Let me explain it to you with this. Uko na account ya $10, ni sawa? Ukaweka leverage ya 1 is to 2,000, which gives you 20,000 worth of currency to trade with. Are you together? Okay, because you are more of, okay, you told me you have, so for example, ukaamua uingie full margin. Branson, that's your work. So ukaamua kuingia full margin. When you're going in full margin, you'll be expecting a lot of together.
Yes.
Now, what the if the market goes against you, that account is going to blow within less than 10 pips. Kwa nini? Umeweka. The entries are benefiting you if they go your side, but if they go against you, you're not going to save that account. Umeelewa? So, leverage is bad.
Lydia, let's say, can I explain something to Lydia? Hello, Lydia.
Yes.
A broker isn't supposed to lose money, but he's lending you money. So when you have a $10 account and you have like a maximum leverage, so you can open 4 positions. No, up to 4, 2 to 4. So you've opened 2 to 4 positions. So you've opened 4 positions, and that market goes against you. If it goes against you like 20 in 20 pips, 1 position will be -2. So with 4 position will be -8. Umeelewa mpaka hapo?
Umeelewa.
So ukikuwa kwa -8 inamaanisha ikisonga tu kidogo against you, hiyo account imeblow. Juu broker haendi kupoteza pesa yake. Unaona? Lakini ikienda to your direction, ikienda 100 pips, uko able kuongeza more entries. Unaona kuna mahali mtu anaweka entries mingi, anazilea kabisa. Umeona kitu kama hiyo? Haeki moja like ati anabai, anaweka mingi. Unaona? Hiyo ni katu hapa, haiwezi teremka kushinda hapa. So ana take average. So pesa yake ikipotea inapotea ni hiyo 10. Lakini in case iende to his direction, is more capable of making a money.
Okay.
Sasa hiyo ndo advantage ya leverage.
So are you guys on the same page up to there?
Yes.
Now, I want us to talk about this concept in another way. We have taken a loan. Are we together, Lydia?
Yes.
Umechukua loan ukafungua kampuni. Then the bank notices that you're going into losses with their money. What are they going to do? Okay, or you don't have the ability to pay. What is going to happen?
They'll auction.
Huh?
They'll auction you.
They'll auction you to recover what? The assets. So
Their
that's
loan,
what happened.
their money.
Amekupea loan uunde nao do, then pia benefit. Basa amenotice wewe badala ya kuunda do mama kufanya nini? Pesa. Wanatoa pesa yao kama wamekuchuja plus na yako. So you're out. So are we on the same concept there?
Yeah.
Beverly, have you got the concept? We proceed. So I was talking, if you have 1,000, use a leverage of 1:100. You can trade 100,000 worth of currency. Now, thing to note is while leverage amplifies profit, it also increases, meaning a small market move can wipe out your. And that's what we just explained right now with the account. Now, moving forward, now let's talk about the power of leverage. A leverage of 1:2. You invest a capital of $1,000, your purchasing power becomes $2,000. If you make a profit of 1%, you make $20. Where your return on investment will be 2% after you have invested what? $1,000. $20 is 2% of $1,000. Have you got that concept there? Lydia, umepata your concept?
Nimepata.
Scenario number 2, a leverage of 1:10. You have invested $1,000. Your purchasing power becomes $10,000. When you make 10%, 1% to make $100. $100 is what? $100 is 10% of the $1,000. So the higher, as you can see, the higher the leverage, the higher the profit, but the higher the risks of losing your money. You have a leverage of 1:50. Capital invested is $1,000, $50,000. A profit of 1% investment is 50%. If you have a leverage of 1:100, a capital invested 1,000, purchasing power 100,000. The profit, you make a profit of 1%, that is $1,000. The return on investment is 100%. You've made 100% of your money. A leverage of 150, 1:150, capital invested 1,000, purchasing power 150,000. 1% profit $1,500. Return on investment 150%. That goes on to 200, which gives you a 200% investment. Are we together on that?
Yes.
Now let's proceed to something else. As everybody understand the leverage and margin?
Yes.
As Lydia and Beverly understood, who has talked about margin, by the way? So margin is more like after you have been given leverage, there's a maximum amount of money you're allowed to, maximum amount of positions are allowed to open. For example, Bryson explained, you have $10. You have given a leverage of 1:1,000. You're allowed to open up to 4 positions. That's the margin. You cannot go more than that 4 positions. Now, when you're in losses, there is that point. We call it more like a breaker point for the broker to let you go. As much as nimekupea my 100,000, my 1,000, I've amplified your capital from 100,000. Kuna place loss yako ikifika, I'm going to cut my losses as a broker. Now that's the margin. It's more like I've invested into your business, nakupea 100,000 Kenyan shillings. But now when you are doing business, I notice there's a certain buffer point umefika, pesa imeanza kupotea. For example, capital at the beginning of the business was 100%, more like let's say 1 billion Kenyan shillings. Then you may notice umefika 750 million and you have not made any profit. Do you know what I'm going to do? I'm going to cut. I'm going to cut the deal with you. So that's more like margin. Is the amount of money you're allowed to lose. There's that buffer point. Hapo kuna mtu anajaelewa? Lydia and Lavin and nani and Beverly.
Nimeelewa hapo.
Beverly, umepata hiyo?
Bado na absorb.
Bado na absorb. Ni explain tena.
Yeah.
Okay. Let me use a practical part of it for the margin. Beverly, we have 1 million Kenyan shillings, ndio?
Yeah.
Investors wamekupea 1 million Kenyan shillings. But now, as much as amekupa hii pesa, see that guy needs to make profit. But sasa amenotice pata wamesema ikifika 75% money I've given you, which is 750 million, I'm going to withdraw my funds. Umeelewa? So hii 250 is the margin you're allowed to use. Umeelewa? Hii 250 ikipotea, we're doing what? Tuna pull out. Umeelewa? So that is all about margin. Umeelewa the margin part? Ulielewa? Okay. Now I'll proceed. Pips, lots, and position sizing. A pip is in full is more like percentage in point. It is the smallest price movement in a currency pair. For most pairs, a pip is the 4th decimal place. So a pip is more like in time, the smallest unit of movement is second, or more like a micro. Okay, let's talk about the second. Achana microsecond. For Forex, for Nani, Lydia, you are a synthetic person, okay? Trader.
Yes.
You guys have something called a pipette, which is smaller than a pip. So we have a pip, which is the smallest pointed movement. For example, the price of USD right now is 1.2881. Then it moves to 1.2880. It has moved with what? 1 pip. Because 1 pip is what? There's a deduction of 1 pip. Apo, is there anybody who has not got that point? The 4th decimal 1.2880 to 1.2881. So that movement, that 0.001 is what we call what? 1 pip. That is for most currency pairs, not all. As I'll be getting to currency, analyzing the market, I'll be teaching different currency pairs and how their pips are calculated. So I'll move on. Is there any question up to there? I'll take that as a no. So, for example, if USD moves from 1.100 to 1.1005, that's 5 pips. For JPY pairs, the pip is the second decimal place. For example, USD JPY, which is at 130.50 and moves to 130.55, it has moved with 5 pips. So for the Euro USD, for most currency pairs are going to use the 4th decimal point as the pip calculation. But for the JPY pairs, who is calling me right now? Hello? Kidogo nikupigie tu, niko class kidogo tu. So sorry for that. For JPY pairs, a pip is the second decimal place. Up to there, are we on the same page?
Yes.
Okay, I'll proceed. Euro USD moved from 1.1600. I'm not sure with that. I'll look for another example as we proceed because I'm not sure with that is 1.1600 unless I have to confirm. Adjust a little bit. So it moved from 1.116 to 1.15. The drop was 115 pips. If you calculate it, use the fourth decimal place. So we'll be working more on that. So what is a lot? Now a lot is more, or I'll ask Lydia. Lydia, so Lydia, what is a lot? Lydia. Brian, so what is a lot? Oh, Beverly, you told me you had started making studying. So do you know anything about a lot?
Yes, but it does have the real definition.
I know that's not the thing that was. That's why I've asked what is a lot from your definition. Hmm?
I know 0.0. I
A lot is
know. I don't know the
okay.
definition. Maybe kuna 0.0, lot size
You're
kuna
ju-
0.1.
so you are naming me the types of lots. Okay, that is fine. Lydia, anything about a lot?
A lot is the position that you are supposed to place when you are trading. Like we have mini lot.
Umeanza kuname size types. Okay, that is a position according to you. Branson? So as much as Beverly has said that's not the definition, Lydia said is the position. A lot is literally the standard unit of trade. It's more like a unit you're using to trade. Now we have different types of lots. We have the mini lot, nano lot, micro lot, standard lot. Kuna like for synthetic people, they use the nano lot. Now, what is a standard lot? A standard lot is a whole number, like one. One is a standard lot. I'm getting me there.
Yes.
A standard lot is one. That's a normal number. A mini lot is 0.1. A micro lot is 0.01. Then a nano lot is 0.001. There are pairs in the synthetics that use 0.001. Back, there's a certain volatility pair. I can't remember it was which. Lydia can confirm to us that with us.
It was V75,
Mm-hmm.
but they changed. Now 0.005. Yes. I think the minimum now is 0.05.
Okay.
Yes.
Now, choosing the right lot depends on your account balance and risk tolerance. Okay, there's a value of a pip according to each lot. Now, more like connected. Are we together on that?
Yes.
So, per pip, what is the value of a pip depending on a lot? When you're trading with one standard lot, one pip becomes worth $10. So if you have a $10 account, the market goes one pip against you, your account is gone, and your margin cannot allow you to trade one pip with one standard lot with $10. Cannot allow that. So up to there, are we together?
Yes.
A mini lot is 0.01. 0.1. 0.1. One pip is equals to one lot, $1. So if you're trading with 0.1, when you're -1 with 1 pip, you're going to lose $1. But if it goes against you $10 is gone. Now we have micro lot, whereby 1 pip is equals to 0.10 dollars. So if you're going to lose pips, you're going to lose $1. So it depends on your account size and your risk tolerance. Umeelewa hapo? But you cannot trade one standard lot on a $10 account. That is possible. Any questions for your part? Now I'm going to ask you any question per concept, because this concept usipoelewa, if you don't understand the pip, the lot, the leverage and the margin, it's not going to be well for you in the market. These are things that you need to know. These are tools that you must know as a trader. So up to there, is there any question on the lot? For those who are on the stream, if you have any question, you can write them on your in the comment section. Then later I'll check at them and make a video for them. So for those in class, do you have any the part lot? Don't be scared. Everybody here is learning. So do you have any question up to there? Beverly, any question? Brian, do you have any question?
No.
Lydia?
I was asking, when the market is moving, the way it is moving, that's a pip.
Not the way. Okay, let's repeat your question again.
Naona vile ukiingia kwa market vile inasonga juu chini hivyo. One movement is a pip.
Yeah, the market moves in pips.
So make a, the way it moves vile na move, hiyo ndio sasa pip, vile market ina move juu na chini.
No, not move chini na juu na chini. Una the points ya juu na move. For example, ilikuwa, let's say for example market yako ilikuwa kwa, let's use USD. Tutumie USD for example. Sawa? Which the price the price is currently 1.2880 na ika move to 1.2879. Ime move na negative 0.001. So that is 1 pip. Umeelewa? So it depends on the currency, the pair that you're trading, where are the pips calculated from?
When you're using dollars, not using pips, let's say you are in $1 and then you move to maybe 1.5, isn't it? Your movement ndio pip.
That's not pip.
What is that movement called?
Yes.
Okay, what pair are you trading? Unaongelea hii ni mambo ya pip, because when there's that movement don't look the movement from money side. Ukiangalia from money side kuna a lot of pips accumulated. Depends on the size unatumia. Okay, let me use an example. Let me use a live market. Nikuonyesha vile inakaa. Sawa?
Yes.
So let's use these. These are markets. Sawa? To here. Mark.
Yes.
Now, I want you to do this. A pip is not the amount of money yenye iko kwa hiyo side ya pesa. The pip is, when you're looking at the movement from this point here to this point here, these are the pips that are the pips of move. So I want you to, do you have a calculator around you?
No.
Okay, can you open the calculator from your phone? Do you have a calculator set?
Yes.
Now take 1.1650
1,
minus
6.
have you written 1.1650?
Yes.
Minus 1.642. 1.1642. 1.1642. No, 1.16. Wait, 1.165. 1.1645. Yeah, 1.1645. What is your answer?
Yes.
What is your answer?
0.005.
0.
0005.
Are you sure?
0.0005.
Okay, 0.0. Now our movement is basically 5 pips. Umeelewa? Have you got the concept of pips?
Yes.
That is 0.0005. We said in USD, we calculate our pip movement from the fourth decimal. 1, 2, 3, 4. The fourth decimal is 5. So our movement is 5 pips. You don't calculate our pips with the profit you're making. So if this 0.005, which is 1, we could be using a lot of 1. From what I was earlier, you will see. Let me move back to that screen so that we can be on the same page. So if we could be using a standard lot, which 1 pip is equals to 10, we will take 5 times 10. To make what? You will make a profit of what? $50 in that what? Movement of 5 pips. Are you together there?
Yes.
Now, if you could be using a mini lot, which is you to take 5 times $1, which becomes what? $5. You could have made $5 from that movement. Are we together up to there?
Yes.
Ukitumia micro lot, you will take the 5 pips times 0.10, which will give you $0.5. So it depends on your lot size. Depends on the lot size. So you see somebody using a higher lot size will make a lot of money from the same movement compared to somebody using a low lot size. But now remember, this guy is using a higher lot size because his account is big. Don't go trade with account ya $10 unataka kuweka standard lot. Hata broker hizi kubali. Beverly, are we together? Have you understood the concept?
Yes.
Now, conclusion. Understanding trading, including currency pairs, bid, ask, spread, leverage, and position sizing as crucial before entering the market. So in the next chapter, we're going to look at trading platforms and tools. So up to there, does anybody have a question before we end our class? Branson, any question or any concern during the class?
Question.
Concern? Thank you for that. We're going to who? Beverly, do you have any question? Hello? You have a question? Okay, ask. The network is buffering, so you can type on the chat. I'm not getting you. Vida, do you have a question?
No.
Okay, with that, I think our class is ended. So, any comments on today's class? We'll start with Granson.
It was a good class on Friday.
Okay.
Says that I appreciate for the time that you are sacrificing so that we can learn. At least I'm gaining, yes.
Beverly?
Mhm. I love Oxford.
Hmm?
That was just fun. Thank you so much.
Okay, thank you. Let us meet on Friday. You guys have a nice, good night. Have a good morning tomorrow. Happy lunch. Oh, sorry. So let me answer a question here. Why you're struggling to get me, but my question is sijaona law says 0.01 ndio tunaita ni tunaita microlot. Umeelewa? Beverly? Okay. Okay, you guys have a good night. Let's meet
Okay, you too.
For those on YouTube, have a great time. Let's meet on our next class.
Okay, thank you.
Welcome. So guys, remember to subscribe, comment, and like on our videos. Have a nice time. Peace. Hello.